I think the market's priced in, and I've talked about this many times, a recession last year. So the year-on-year rate of change, I'll show the chart later, of the NASDAQ got down to expecting the ISM to get to 37, deep recession. So we're on the backside of that as future liquidity is increasing. But also, a simple thing is if you go back to 2018, the moment the Fed paused, the market's ripped. I've always said, after you've gone through a whole miserable year like last year, and you've got things like technology that's advancing, the narrative kind of builds and builds and builds, and the Fed take their foot off the beach ball and it's underwater, it explodes higher. And so you've got this kind of crazy disconnect where people can't get their heads around why the markets are rising. And it's both a matter of, oh, finally we can own equities and take some risk again, but also there is an underlying forward-looking element of the liquidity cycle and the business cycle that's priced. We're still in the downside of the business cycle that Darius and I will both go through in a bit, but markets often like to look forward somewhat, and that confuses people. People always look at today as the snapshot. Today's actually never the day. Today's news is not the important news. The important news is what's going on in the forward-looking stuff.
Veteran investor Jim Rogers, who co-founded the Quantum Fund with billionaire investor George Soros, says he expects the next bear market to be the worst in his lifetime. You should be extremely worried. If you're not, you don't know what's going on, he stressed, adding that there will be trouble in all markets. Hello and welcome to Money Talks. In today's video, Raoul Pal, CEO of Real Vision, shares his beliefs on money growth, the risks of deflation versus inflation, and will the Fed stop rising the interest rate or not?
But what I've kind of unpacked within this is, yes, liquidity, the regular styles of liquidity, but there's the different style of liquidity, which seems to be the Fed balance sheets, that I think is a debasement of currency. So all assets rise versus the denominator, which a lot of people can't get their heads around. And so optically, everything goes up. So I started using a different denominator to look at asset prices. Like the S&P's pretty much gone nowhere since 2012 if you use the balance sheet.
Yep.
In fact, real estate, gold, S&P 500, nowhere. While NASDAQ, crypto, up a lot. With NASDAQ one, crypto the other. Okay, because they're both secular adoption curves of technology. So you can understand why it does it. So that's the difference I've got with liquidity to most, this debasement idea, and that it has a very different, profound impact. In the Everything Code, and I'll send it to you, Darius, because it's like 18 years of work, and I got to, I think it's a thesis, it's a hypothesis, but I think I've got to figure out why it happens, which is, I think it's to do with the monetization of the interest payments of every of the major governments every 3.5 years, which is between the 3-year and 5-year average duration of their debt, which has made the ISM completely cyclical because everybody reset interest rates to zero. We had a global, I only realized this recently when I wrote the article. In fact, after I wrote the article, the global reset everyone's worried about or wanted or thought about happened in 2008 when all rates went to zero with basically a debt jubilee.
Yeah, it was.
There's no payments at that point. So what's happened since then, the refi of the debt has created this cyclicality. And I figured out, and I'll show you the chart, which I've never shown outside of GMI so far, I'll show it in a minute, is that the interest payments exactly mirror Fed balance sheet growth. And I was like, holy shit, I discovered this by mistake. And I'm like, holy shit. And then it went down the rabbit hole that I then did the same for the UK, Europe, Japan, and they're all the same. So they're all monetizing their interest payments. So that's what ends up in the balance sheet plus any banking crisis, right? So that's the extra delta that adds on top. So then I started looking at it and realizing I think I've got I can look forward on the monetary cycle in this way because we've got forward-looking indicators. Now, are they going to hold all that stuff? Who knows, right? But I think I can look forwards, and I think I can look forwards out till end of 2025. And because of with our weekly liquidity index gives us a 97.5% correlation with the S&P 500, NASDAQ as well, that we can put prices on assets going out to 2025.
Veteran investor Jim Rogers reiterated his warnings about the biggest market downturn and the U.S. dollar losing its global reserve currency status during an interview with Real Vision last week. Rogers is George Soros's former business partner who co-founded the Quantum Fund and Soros Fund Management. He cautioned, "The next bear market will be the worst in my lifetime because the debt has gone up by such staggering amounts in the past 14 years. Rogers reiterated his previous explanation that the U.S. experienced a bear market in 2008 due to excessive debt. He pointed out that since 2009, the debt level worldwide has skyrocketed. "We should always be concerned about Washington. They don't have a clue what they're doing, and they prove it day in and day out," he opined.
Why is this happening? All the major governments got to 100% of GDP in debt, except Japan, which is 260, whatever it is. So when they get to 100% of GDP in debt, most of their private sectors are about 100% of GDP in debt, more or less. So if interest rates are at 2% and GDP is growing at 2%, I think of GDP growth as your income to service your debts.
It is.
So therefore, the government crowds out all of the private sector just by its interest payments. And in which case, the economy will keep shrinking by the amount that the private sector has to pay. So what they've done is removed the government interest payments. So then you've just got the corporate sector. And that is why, it's one of the reasons why it ends up on the balance sheet, but GDP is slow because we've got these gigantic interest payments. Because as you know, nobody pays off their debt. They just keep adding to it and refining it, and it keeps going. So that's what I kind of have figured out. And I'll show you some charts of this. But yes, it's the reason that's why the government can do it. It sticks it all on to not crowd out the private sector, because if not, everything blows up. So here's some of the charts. So we found, and you're familiar with this, is we found that the rate of change is actually probably more important.
Agreed.
Overall, but the overall trend of liquidity works very well as well. We both get high R-squareds from doing this against multiple assets. So here's our weekly global liquidity. This is the G5 central bank balance sheets, this version. We've got some monthly ones. We've got various different liquidity indicators, but this one works extremely well.
The renowned investor also believes that the U.S. dollar will lose its status as the world's reserve currency. Discussing the global de-dollarization trend, he emphasized that numerous countries are actively seeking alternatives to the U.S. dollar, partly due to concerns over its substantial debt issue. Moreover, he mentioned that the weaponization of the U.S. dollar creates an incentive for nations to reduce reliance on the USD. He warned, "You should be extremely worried. If you're not, you don't know what's going on." Rogers shared that he is looking every day for an alternative to the USD because he knows something bad is going to happen in the currency markets in the next 2 or 3 years. He recently said that the U.S. dollar's time is coming to an end as countries seek alternatives to the USD. The veteran investor also expects interest rates to increase worldwide. While admitting that he does not know how high central banks will increase interest rates to curb inflation this time, he stressed, "The world has never seen the debt and the spending and the money printing like in the last few years, so something is going to have to be very, very ruinous to solve this problem this time." Rogers warned, "There'll be trouble in all the markets: property markets, stock markets, bond markets, currency markets, everything."
Here's the chart that I've not shown anybody yet. This is the Fed balance sheet versus the interest payments leading by 36 months. And this goes back all the way back to the beginning of QE, and it's amazing. Now, it's suggesting now should be in the, obviously we had this little spike from the banking issue. Now it suggests that it should be slowing down in its rate of change and eventually start going up in Q3 and C, right? We've never used this before as a forecasting tool, but the correlation between this and the longer term version of this was pretty staggering. It's like, holy shit, it's just 36 months delayed payments is coming on the balance sheet. So that's the big hypothesis.
So, is it a good time to invest in Bitcoin? And what's your prediction for Bitcoin in 2023? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.